When you are investing the money in long-term assets, we call that money as fixed capital. The long-term sources of capital are equity share capital, preference shares and debentures, long-term loans and retained earnings. What do we mean by technology upgradation? So it involves upgrading the existing machinery of the organization. Hello everyone, I am Purnima, faculty in the Department of Commerce, Vidhyaashram Pre-University College, Temple of Excellence. In this session on financial management, I will be dealing with the terms fixed capital and working capital. Now, before we look into what is fixed capital and working capital, let us look into the terms fixed assets and working or current assets. Now, we all know that fixed assets means land and building, plant and machinery, furniture and fixtures, or those assets will be in the business for a very long time. Now, what do we mean by current assets? Current assets are those which get converted into cash within 1 year of the organization. Now, we'll just look into what is the meaning of the word fixed asset and current asset, and later on let us look into the meaning of fixed capital and working capital. Now, here what do we mean by fixed and working capital? Before that, let us understand the meaning of the word fixed assets. Now, fixed assets are those which remain in the business for more than 1 year, usually for much longer. That is, plant and machinery, furniture and fixtures, land and building, vehicles, etc. Okay, so we all know that fixed assets and current assets are essential for running an organization. So, whenever we purchase fixed assets, it will be there in the lifetime of the company. So, the fixed assets will remain in the company and it will serve the company for a very long time. But then, fixed assets require large amount of investment. Now, before we invest in the fixed assets of a company, it is essential for the company to decide whether they have to actually purchase the fixed asset or they can go in for rent of the fixed assets. Now, so this is a most essential part of the capital structure decision or the investment decision, what we call. Now, why we should carefully consider the investment here? That is because the fixed assets require lot of investment, and once we make an investment, the decisions are irreversible. And once we make the investment, when we have to just sell the fixed asset or when we have to reverse the decision, it will be always at a loss to the company. So, therefore, whenever we have to make an investment in fixed assets, it is essential for the organization to think twice before investing in fixed assets. Now, here we have understood the meaning of the word fixed asset. Now, let us understand what we mean by the current assets. Now, current assets are those assets which in the normal routine of the business get converted into cash or cash equivalents within 1 year. That is, inventories, debtors, bills receivable, etc. Now, these current assets are those assets which get converted into cash within 1 year. So, examples of current assets are inventories. That is the stock available in the organization. It may be the stock of raw materials or stock of partially finished goods or the stock of finished goods. They all will be termed as inventory. Then we also have the debtors. So the debtors are those for whom the company has given the loans, are those customers for whom the company has given loans. Then also the bills receivables. So the bills receivables are the bills which are drawn on our customers. So these current assets are easily convertible into cash within a period of 1 year. Now, the money through which you buy the current asset, we call it as the working capital, and the money which you use to buy the fixed assets, we call it as fixed capital. Now, let us understand what is the meaning of the word fixed and working capital. Now, the fixed capital refers to the investment in long-term assets. So, the management of fixed capital involves allocation of firm's capital to different projects or assets with long-term implications for the business. Now, fixed capital refers to investment in long-term assets. So, when you are investing the money in long-term assets, we call that money as fixed capital. Now, when you are taking a decision relating to fixed capital, it will involve allocation of firm's capital to different projects. The firm will be having so many projects and you will have to allocate the money for the various projects which will give the returns for a very long time. Now, these decisions are called investment decisions or capital budgeting decisions and affect the growth, profitability and risk of the business in the long run. These are long-term assets last for more than 1 year. So, whenever a decision is to be taken for a fixed asset, for the purchase of a fixed asset, then we call those decisions as investment decisions, or we can also call them as capital budgeting decisions. Now, once these decisions are taken, they will affect the growth of the firm, they will affect the profitability of the firm and also the risk of the business. So, it is essential for all of us to think twice before we invest in fixed assets. Now, if suppose there is a proposal to buy a land and building for the company, so a new company is being started and there is a proposal to buy land and building. Now, the company has to think twice before it purchases this land and building. Why? Because land and building or the building can be taken on lease or on a rental basis. So, we can avoid heavy investment in that particular area. Now, if the company has very good returns or if the company is doing very well, then it can go in for purchase of the land and building. Suppose the company is a new company and it has to just stabilize itself, then in such a position, it will not be able to just afford to invest lot of money only on land and building or on plant and machinery. So, it has to consider various other options available through which it can just secure the assets. So, it can go in for rent or it can go in for lease of machinery, lease of rent, land and building, etc. So, through all these other decisions also, these fixed assets can be acquired, and hence we say that the investment or the investment decision or the capital budgeting decision will affect the growth of the organization. It will also affect the profitability of the organization and also the risk of business will be more. So, we have to take certain factors into consideration when we just take a decision regarding the fixed capital and purchase of fixed assets. So, we have understood the meaning of the word fixed capital. Now, let us look into how this fixed capital can be sourced. Now, it must be financed through long-term sources of capital such as equity or preference shares, debentures, long-term loans and retained earnings of the business. Fixed assets should never be financed through short-term sources. So, whenever there is a purchase of fixed assets, it should always be through the long-term sources of capital. Now, let us consider what are the various long-term sources of capital. Here, the long-term sources of capital are equity share capital, preference shares and debentures, long-term loans and retained earnings. Now, what do we mean by raising the funds through equity shares? That is, you are issuing shares to the public and then you will be collecting money from the public in the form of equity share capital. Now, what do we mean by preference shares? So, you will be issuing preference shares to the public and collecting money in the form of preference share capital. Then, what are debentures? So, debentures is the loan capital of the company and through the debentures, you will be raising the money. So, the money invested by the debenture holder will be considered as the loan to the company and the company will be paying a fixed amount of interest to the debenture holders and these debentures will be redeemed after a certain specific period. Now, the next type of source is the long-term loans. So, the long-term loans will be given by the government and other institutions which are always there to encourage the industrialization of the company, and also the retained earnings. So, the retained earnings is one source of earnings, or it is one source of long-term funding. So, this retained earning is that part of the profit which has been retained in the company. Whenever the company has plans for expansion, it can always make use of this retained earnings. So, these are the various sources through which the company can have long-term funds to fund its fixed assets. Now, the fixed assets should never be financed through short-term sources. So, there is a word of caution here. Now, what is the caution they are telling? We should never fund the fixed assets through short-term sources, because these short-term sources, we'd have to pay very small percentage of interest, but then the period for the repayment will be very high. So, whenever we are funding the fixed assets of a company, it is always essential for the company to fund it through fixed capital or through long-term sources of capital. Now, investment in these assets would also include expenditure on acquisition, expansion, modernization, and their replacement. These decisions include purchase of land, building, plant, machinery, launching a new product line, or investing in advanced techniques of production. So, whenever we are investing in fixed assets, there are certain causes for which we have to invest in fixed assets. So, what are the various expenses and fixed assets? First one is expenditure on acquisition. So, whenever a large plant and machinery is being imported from a foreign country, then there will be lot of expenditure involved in acquisition of the machinery. There will be so many import restrictions and so much of import fees to be paid to the government before we acquire the machinery. So, that expenditure on acquisition, that will be a part of the fixed asset. Then expansion, modernization. So, whenever the company wants to expand its operations or it wants to have a new branch in a new country, then also there will be a lot of requirement for fixed capital. Then modernization. So, modernization means you are upgrading the technology of the company. Whenever the latest technology is available in the market, the company has to upgrade itself to the latest technology, as a result of which we have to replace all the existing machinery. Now, the replacement of the existing machinery will involve lot of fixed capital. Then, so whenever we have to do all these activities in the organization, it will require a large amount of capital, which we can call as the fixed capital. Now, these decisions include purchase of land. So, when you want to expand your business and the existing area is not sufficient, then we have to purchase extra land for our operations. Then, next is a building. So, we need a building to expansion purposes. Then, again, we have to construct a building on the land which we have purchased. Then, the plant and machinery. Whenever there is a technological advancement, then we have to get the latest plant and machinery for the organization. Launching a new product line. That is, whenever the company has to diversify its activities, so it will add a new product to its product line which has to be launched, and launching of this product line will involve huge amount of fixed capital and advanced techniques of production. That is, so whenever the latest technology is there, the company has to upgrade itself, and all these activities require a large amount of fixed capital, and hence it is essential for the company to make all these investments so that the company will grow and make more profits in future. Now, let us look into the various factors which affect the fixed capital. Now, the Management of fixed capital or capital budgeting decisions are most important for the following reasons. Now, before we just have an investment in fixed capital, let us understand why it is very important to decide about the fixed capital of the organization. The first one is long-term growth. The funds invested in long-term assets are likely to yield returns in the future. These will affect the future prospects of the business. Now, the first factor which affects the fixed capital is the long-term growth. So, whatever funds you are investing, so these funds will affect the business for a very long time, because if you are purchasing land, if you are purchasing building, if you are purchasing machinery, etc., they will be there in the organization for a very long period. That is, even up to the lifetime of the organization. Hence, these decisions have to be taken with extra care and extra effort. Then, so they are likely to yield returns in future, and they will also affect the future prospects of the business. So, all these decisions have to be taken with consideration. Then the next factor which affects the fixed capital is the large amount of funds involved. So these funds investments are planned after a detailed analysis is undertaken. This may involve decisions like where to procure funds, at what rate to invest. So there is a large amount involved in this acquisition of fixed capital. Now, whenever we have to raise fixed capital, we have to think of the various sources through which we can raise the fixed capital. The fixed capital can be raised through equity shares, preference shares, debentures, or through retained earnings. Now, the decisions involving this fixed capital also involves the whether you have to purchase the asset or whether you can always borrow it on rent. So, in this way, this fixed capital, or whenever you have to invest in a fixed asset, there we have to be very, very cautious. Now, the third factor which influences the fixed capital is the risk involved. So, investment decisions involving fixed capital influence the overall business risk complexion of the firm. So, whenever we are making an investment decision, we have to consider the various factors. That is, what is the return involved in the investment. So, if you have to make an investment in a fixed asset, we have to first calculate what are the returns, what is the rate of return, and what is the rate of interest which we will be paying on procurement of these funds. So, after a careful analysis of this, only then we have to take an investment decision. Now, the next one is irreversible decisions. So, these decisions once taken are not reversible without incurring heavy losses. Abandoning a project after heavy investment is made, is quite costly in terms of waste of funds. Now, the fourth factor which influences the amount of fixed capital is irreversible decisions. So, as I had explained to you earlier, so whenever you make an investment decision, it is essential for us to just look into the pros and cons before we have to invest this huge amount. Why? Because once we take these decisions, they are irreversible, or even if you want to reverse these decisions, there will be a lot of losses for the company. Suppose you buy a plant and machinery for the company, and then you know that the plant and machinery is available on lease, then you will be just regretting why you made such a lot of investment on plant and machinery. Now, if you want to sell the plant, then the plant will not get sold at the price which we have paid, and in addition to that, we would have spent lot of money on the installation charges of the plant, etc., and all this will be a huge loss to the company. So, therefore, it is essential for us to think twice before we invest in the fixed assets of the company, and investment decisions have to be carefully analyzed after careful analysis only, we have to take the investment decision. Then next, let us look into what are the various factors affecting the requirement of fixed capital. Now, the first one is the nature of business. The type of business has a bearing upon the fixed capital requirements. Now, suppose the company is involved in a trading activity. So, a trading activity involves you just buy from the wholesaler and sell it to the ultimate consumer. So, this type of a trading activity does not involve large amount of fixed assets. So, you will be needing more of current assets other than the fixed assets. So, if you have a building and if you have a certain amount of furniture, that will be very sufficient. So, you just purchase goods from the wholesaler and you just sell it in the shop. So, this kind of a trading concern will not involve huge amount of fixed assets. But then, if your business is relating to manufacturing, which involves huge amount of machinery, etc., then we will have to purchase the machinery, we will have to purchase the building, or we may have to rent the building, and we may have to hire technicians who are well known, who know how to handle the machinery, etc. So, when this happens, we need a lot of money for fixed assets. So, depending on the nature of the business, we have to decide about the fixed capital requirement of the company. Now, the second factor affecting the requirement of fixed asset is the scale of operation. A larger organization operating at a higher scale needs bigger plant, more space, etc. Therefore, requires higher investment in fixed assets when compared to small organization. Now, the next factor affecting the fixed capital is the scale of operations. So, if you want to do your business on a very large scale, then it will require a very big plant. That is, you will require a very huge machinery, etc., more space, etc., and therefore requires higher investment. So, when you are operating on a very large scale, then you may need lot of capital for that. But if the scale of operation is low, or if you want to run a small scale industry, then the requirement of fixed capital will be proportionately lesser. Then, the next factor affecting the requirement of fixed capital is the choice of technique. Now, what do we mean by choice of technique? Some organizations are capital intensive, whereas others are labor intensive. So, a capital intensive organization requires higher investment in plant and machinery as it relies less on manual labor. The requirement of fixed capital for such organizations would be higher. Now, there are two types of organization. One is called as the capital intensive organization. The other one is the labor intensive organization. Now, what do we mean by capital intensive organization? So, a capital intensive organization will need large amount of machinery. So, whenever it is fully mechanized plant which we are having, then it will require lot of funds for the building and also the machinery. But if the business organization is a labor intensive one, then we will require huge amount of labor but lesser amount of fixed assets. So, depending on the proportion of fixed assets required for the business, we have to decide about the fixed capital for the organization. Then, the fourth important factor affecting the requirement of fixed capital is technology upgradation. In certain industries, assets become obsolete sooner. Higher investment in fixed assets therefore be invested. For example, computers become obsolete faster and are replaced much sooner than furniture. Now, what do we mean by technology upgradation. So it involves upgrading the existing machinery of the organization. Suppose the company has purchased machinery 5 years back and it is running its operations through the machinery, then there may be latest technology in the market which will do the same work and which will be more faster and more efficient. So when such machinery is available in the market, the company has to upgrade itself, or it has to purchase such machinery so that its operations will be more efficient and more effective. So for example, computers, as we all know, the newer versions will be always available in the market and they have to be changed whenever the latest versions are in the market. So it is advisable for the company to change its computers periodically. The next factor affecting the requirement of fixed capital is the growth prospects. Higher growth of an organization generally requires higher investment in fixed assets. Even when such growth is expected, company may choose to create higher capacity in order to meet the anticipated higher demand quickly. Now, what do we mean by growth prospects? The higher growth of an organization generally requires higher investment in fixed assets. Now, what do we mean by higher growth? So you want to expand your operations, or you want to expand your scale of operations. You want to open branches in almost all the countries all over the world. When you have a large scale expansion plan, then such plans require huge amount of fixed assets. Now, even when such growth is expected, a company may choose to create higher capacity in order to meet the anticipated higher demand quickly. So when there are plans for expansion and the company knows that there will be a lot of demand for the products of the company, then the company has to see that it has higher capacity to produce in order to meet the demand of the market. When there is such anticipation for the demand, in anticipation of the demand also, the company may have to go in for lot of purchase of fixed assets, for which we need lot of fixed capital. Then the next factor affecting the requirement of fixed capital is diversification. Now, what is the meaning of the word diversification? A firm may choose to diversify its operations for various reasons. Now, with diversification, fixed capital requirements increase. A textile company is diversifying to start a cement manufacturing plant. Now, what is the meaning of diversification? Now, the company wants to be there. It wants to do business in every sector of the society. Suppose if it is running a textile industry, now it wants to start its own brand of having a cement industry. Now, then after the cement industry, it may go in for a new product line, that is food products. So, in this way, the company wants to just cater to all types of customers in the market. When the company has such plans, it has to diversify. Now, this diversification of its activities require lot of fixed capital. So, whenever you need lot of fixed capital and fixed assets, then we have to ensure that there is a proper source of funds which caters to the fixed capital of the organization. So, this fixed capital is an essential part for diversification. Then, the next factor affecting the requirement of fixed capital is financing alternatives. A developed financial market may provide leasing facilities as an alternative to outright purchase. When an asset is taken on lease, the firm pays lease rentals and uses it. By doing so, it avoids huge sums required to purchase it. What do we mean by financing activities? So, in this financing activities, we should understand that the financial market offers various avenues of financing. Suppose the company wants to purchase a machinery, it can do so not by actual purchase, but it can always purchase it on a lease or rental basis. Now, when the company has all these options, it can easily go in for this lease option because it will be cheaper in the long run, and also the depreciation involved will be higher. So, whenever we go in for a lease option, the company has to calculate what is the return on that particular machinery and what is the lease you will be paying, and only after a careful comparison we have to go in for this leasing facility. Then the last factor affecting the requirement of fixed capital is the level of collaboration. At times, certain business organizations share each other's facilities. For example, a bank may use others' ATM, or some of them may jointly establish a particular facility. This is feasible if the scale of operation of each one of them is not sufficient to make fully use of the facility. Now, the last factor affecting the fixed capital is the level of collaboration. Now, what do we mean by level of collaboration? So, whenever there is a facility which has to be provided to the customer by, so for example, if you take the example of ATM, before we could use only that particular bank's ATM to go and draw that money. Now all we can go to any of the ATMs and draw the money. This kind of collaboration between banks is possible because this kind of a facility is made for the convenience of the public. So whenever there is an ATM facility, so you can go and put any card and then draw the money. So why this is happening? It is because of understanding between all the banks of that particular area. Now, why they have gone in for collaboration? Because they know that if they operate individually, it is not feasible. So, it will be more costly for the banks if they operate individually. Hence, they go in for collaboration of these facilities so that the ATMs are available to the customers for their convenience. Now, these are the various factors which have affected the decisions regarding the fixed capital, or we can also call it as the capital budgeting decisions. Hope you have all understood this session on fixed capital. Thank you.